The May jobs report just made the Federal Reserve's job harder, and markets felt it immediately. The US labor market came in stronger than expected last month. Hiring held up, unemployment stayed low, and the numbers pointed to an economy that simply refuses to slow down. That sounds like good news, and for workers, it largely is. But for investors hoping the Fed was done raising interest rates, it was a problem. Here is why. The Federal Reserve has been raising rates aggressively to bring inflation down. To feel confident about stopping, it wants to see the labor market cool. When jobs are plentiful and paychecks keep coming, consumers keep spending. And when consumers keep spending, prices tend to stay elevated. A strong jobs report tells the Fed it may need to do more, not less. Markets repriced that risk fast. Stocks fell, with technology shares taking the hardest hit. That is not a coincidence. Tech and growth companies are valued largely on profits expected years from now. When interest rates rise, a basic financial concept called discounting means those future profits are worth less in today's dollars. So investors sell, and that is exactly what happened. Bond markets moved in the same direction. When traders expect rates to stay higher for longer, they demand more yield to hold government bonds. Prices fall, yields rise, and borrowing costs go up across the board for businesses, home buyers, and everyday consumers. The broader picture here is one of an economy that has proven more durable than most forecasters expected. That durability is genuinely good for workers, but it keeps the Fed in a difficult position. Officials have been clear that they need convincing evidence, not just a hint, that both inflation and the labor market are cooling before they consider easing policy. The May data pushed that moment further out. So what happens next? Two things will matter most. First, upcoming consumer price index readings. The CPI measures how fast prices are rising for everyday goods and services. If inflation stays firm alongside a strong job market, the case for another rate hike, or at least a long pause at current levels, gets harder to argue against. Second, any fresh signals from Federal Reserve officials about where they see rates heading. Markets are now recalibrating around the possibility that the Fed is not finished. That shift in expectations is what drove stocks lower and yields higher. Not panic, just a straightforward reassessment of the rate path. The practical takeaway: watch the next inflation report closely. It will either confirm that the Fed has more work to do, or give it room to hold steady and wait. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.